Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning before the market opens, with the stocks to watch and the stock market news for this week. And Nation, the tech-heavy Nasdaq officially entered correction territory last week, down more than 10% from its peak, and just the sheer value destruction in big tech has been astounding. Shares of Amazon lost $170 billion in value Friday alone. Nearly $140 billion has been wiped off Tesla's market value since it reported, and Nvidia investors have seen $690 billion in valuation evaporate in less than a month. We aren't to the stages of panic we see in a market crash, and there is still a reason to buy the dip, but anyone in these big 7 tech stocks needs to sit up and understand what is going on. That's why I wanted to walk through these recent earnings and the news in each of the Magnificent 7 stocks. That's Apple, ticker AAPL, Nvidia, NVDA, Tesla, TSLA, Amazon, AMZN, Google, GOOG, Alphabet there, Microsoft, MSFT, and Meta Platforms, ticker META. We're going to cover news, analysis, my price targets for each stock, and the big issues that you need to know before you invest. But first, if you're worried about a stock market crash, options investing can be one of the best tools to reduce your risk and create cash flow. That's why I'm relaunching my Ultimate Options course over the next 3 days. In this course, I'll take you step by step into 29 strategies to lower your risk, increase returns, and even one option strategy that will make your money back fast in a losing stock. Whether you've never invested in options or already know the basics, this course is going to teach you everything you need to know. Over 3 hours of video, I start with the basics, then walk you through each option strategy, when to use it, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Right now, I'm relaunching the course at a 38% discount. Save $150 off, but only over the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using that best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or scan the QR code here. Back to our main topic though, and what started as just a simple and healthy rotation in stocks has metastasized into a market rout, and while I still believe it's a buy-the-dip opportunity with the bull market going into next year, you need to know why those big tech stocks are falling so fast. Each of the Magnificent 7 tech stocks, again that's Apple, Alphabet, Meta Platforms, Microsoft, Tesla, Nvidia, and Amazon, are all down over the last 3 weeks, and some by double digits since highs set earlier last month. Worse though is the acceleration in selling that we saw last week, and the massive drops some of these went through on their earnings reports. What was at first just a normal rotation for some very expensive and overweighted stocks into maybe some of the more underappreciated parts of the market is now adding some real fundamental issues like heavy investment spending and worries about the economy, and then pushing these stocks beyond that normal dip. I want to get into our analysis on each of the Magnificent 7 companies, so I don't want to spend a lot of time here talking about the big picture economy or the market outlook. I outlined last week why the bull market is still alive and nothing has really changed. Yes, the economy is slowing, but we already knew that, and in fact, it was necessary to get the rate cuts that we need. Now, everyone freaked out last Friday when the U.S. economy posted just 114,000 jobs created last month. That was well under expectations and the lowest in years. The unemployment rate also ticked up to 4.3% and triggered what's called the SAM rule as a predictor of recessions, but stepping back, the economy isn't in that bad of a shape. The jobs market is still pretty tight, with the unemployment rate lower than where it's been for most of the last 20 years. A shortage of workers and low participation has been driving up wages for years, and we needed that slowdown in hiring. What's more, because of the weather in Texas last month, it's likely Friday's report was actually skewed lower, and we're going to see a bounce back in September. We've also talked about the $42 trillion of investable cash sitting on the sidelines just waiting to be unlocked by those lower interest rates. With Friday's jobs weakness, the market is now expecting not 1, but 2 rate cuts at the September meeting by the Fed, lowering rates by a full 0.5%. Through the CME FedWatch tool, we see expectations for rates to be as much as 2% lower by July of next year. A drop of 2% in rates in over less than a year? Do you realize how much money that would save anyone with a mortgage over the last 2 years? How much in refinancing and HELOCs that would unlock, and just the boost to corporate profitability. But just as I warned in our July 15th update, even if the market does hold up fairly well, it's going to feel a hell of a lot worse for investors with that overweight exposure in the big tech Magnificent 7 stocks. So I want to work through each of these. Again, Apple, Meta Platforms, Microsoft, Amazon, Tesla, Alphabet, and Nvidia here. Analyze where each is at and the current news. Starting with Apple, ticker AAPL, which actually saw a 2% bump when it reported earnings last week. The big news was that while overall revenue was up 5% from last year, iPhone sales were down 1% and dropped for the second consecutive quarter. The services revenue was up a strong 14% though to make up that difference. Now, as we'll see with most of these big tech stocks, it's all coming down to AI. Now, how much is the company spending and when will it add to revenues? Apple has been slower to talk about AI than the others, but did unveil its Apple Intelligence Suite with new features back in June. The more modest plans and much lower investment spending on AI has helped the stock so far, but now investors are starting to worry if Apple isn't too far behind. The rollout of features is only going to be available in the iPhone 15 Pro out in September, and even that, not all the features are going to be ready by then. With that weakness in iPhone sales lately, really the company's bread and butter sales here, there is a lot riding that the AI rollout in September to spark a kind of a consumer refresh cycle. For a clue into that, one thing I would be watching as we get closer is what numbers Microsoft and other PC laptop makers are going to be reporting over their second and third quarter earnings. Microsoft started rolling out its Copilot AI features in PCs last May, so that could give us a sense of how eager consumers are to refresh their devices just to get those features, and whether Apple is going to be able to meet those high hopes for its launch sales. That said, expected revenue growth of 8% this year and next doesn't seem like a big hurdle to make. Earnings growth of 15% is expected to slow to 10% next year, so there does look like some of those spending issues hit profitability, like we'll see with these other stocks. With the shares at around 34 times price to earnings and almost 9 times on a price to sales basis, it's a little bit pricey here given that everything is riding on this September rollout. Also, as a consumer company, the more news we hear about a slowing jobs market and the economy, the more it could weigh on Apple stock. I would want to see it closer to maybe $200 before buying, unless we see some very good numbers from Microsoft on those people refreshing their PCs for Copilot. Otherwise, I'm not sure the September rollout could be enough. Meta Platforms, ticker META, has been the big winner of the group, with shares jumping 10% on its earnings announcement. What was surprising was that Meta has also been spending heavily on its AI plans and warned earlier in the year that it would weigh on results, but it seems to be monetizing faster, so avoiding some of the fears that we're seeing with these other big tech companies. Revenue growth of 22% over the year to the last quarter was the strongest among the Mag 7 stocks after Nvidia on a rebound in that really digital ads market, and earnings jumped 73% on cost cutting over the last few years. Meta boosted its third quarter guidance also to just under $40 billion revenue against expectations for $39.1 billion, so that also helped sentiment boost as well. The company did say that capital expenses, so that investment spending, would be as high as $99 billion this year, but that AI spending was paying off, with Old Zuck saying that Meta AI is on track to be the most used AI assistant in the world by the end of the year. Revenue growth is expected to slow to 13% next year, but I think Meta's decision to open source its AI has been a really big success, bringing on more users, and it's going to ultimately pay off with that higher expected growth. It's not cheap here at 25 times price to earnings and almost 9 times price to sales, but the pace of growth does deserve that valuation. I would be adding on any dips and even accumulating at this price. Shares of Microsoft, ticker MSFT, fell almost 2% on its earnings report, even though results were overall pretty good, which tells me the stock was just a little too expensive pre-earnings. Like sometimes the stock is running so high that really good isn't good enough to keep from some profit taking. Overall, revenue was up 15% from the year ago period, but profit only rose 9.8%. So here we are seeing that drag from the higher spending and the costs, pushing revenue growth down into lower earnings. Now, the guidance for 14% revenue growth in the current quarter also came slightly under expectations, so that did weigh on the stock a little. It's in the separate segments where we really got the news. Azure and cloud, the big growth drivers for the company, did well at 29% growth, but it's a slowdown from 31% last quarter. Management said they expect that back up in the first half of next year. I'm also watching these Office 365 and Office consumer numbers very closely, as I think it's going to give us a clue on to how quickly consumers are refreshing their devices for those AI features. Microsoft started rolling out its Copilot AI in laptops and PCs in May, so we could see that growth accelerate if consumers are buying into it. Microsoft is one of the few among those big tech stocks expected to grow revenue faster next year, growing from a 13.9% pace this year to 14.3% next. Earnings are also expected to do well, growing at a 16% pace over the next year. That said, Microsoft is trading more expensively than some of these others at 35 times price to earnings and just under 13 times price to sales. With an operating margin of 43% though and good outlook for revenue growth, I think you can keep adding to a position here around $400 a share, but it wouldn't hurt to save some cash back for more aggressive buying if the stock does fall below this point. Amazon, ticker AMZN, was another big loser this earnings season, with shares slammed 9% Friday alone. Revenue was up 10% from last year as expected, and earnings beat forecasts, but the company guided to weaker revenue growth this quarter and really spooked the market on the size of its investment in AI. AWS cloud services and the advertising business both grew about 19 to 20% and are strong growth drivers here, while we did see weakness in those core e-commerce sales. Now, management did try to blame a chaotic news cycle like the election and Olympics for a distracted consumer and those lower e-commerce sales. Frankly, it kind of sounds like bullshit to me, but I'm willing to give them the benefit of the doubt for one quarter. Now, if we do keep seeing weaker e-commerce sales and that shifting excuses, you're going to know it's more market share losses to competitors like Temu, so be watching for that. That could be a big warning. Really at issue was the 50% increase in capital spending to $17.6 billion for the quarter, all those AI chips and the infrastructure for those new data centers. Not only is Amazon trying to build out its own AI software for services, but that AWS cloud services means it also has to spend on building out the infrastructure for that boom in data center demand. CFO Olszewski repeated a lot of the talk we've heard from Microsoft and Google, saying it's a high-stakes business, a revolutionary shift in a lot of industries, and a lot of money at stake here. And here, I think it's that kind of thinking, that kind of talk that we have to spend as much as possible in this AI arms race that is spooking investors, that it's going to be years before any payoff in revenue is worth it. Here in Amazon, there was enough to like in the earnings to keep me invested, and I like the opportunity at a lower price, but we could see it test $150 a share over the next few months. The uncertainty we saw in earnings and just the idea that we're going to go through a period of even up to a year for much higher capex spending that's going to limit profitability, I think it's going to scare a lot of investors. If you know anything about Amazon, though, it's always been the company that spends big to grow big, and it always ends up delivering on that top-line growth, so I'm comfortable buying it on the way down. Tesla, ticker TSLA, is the outlier among the Magnificent Seven stocks because its issues are really unrelated. Shares are down 17% over the last year, and while it had a really nice rebound in June, the stock slumped 12% on its earnings July 23rd, which really brought up a lot of the problems investors need to know about. Revenue last quarter was up only 2% from last year, and the big surprise was that auto segment. The major driver here saw revenue down 7% over the year. Higher spending and a weak revenue growth meant earnings of 52 cents missed the 62 cent forecast by a long shot. Price cuts on the cars is killing profitability, and the profit margin is down to 14.4% from 18.9% last year, which is a huge change in profits. And sitting through the Tesla earnings call, I got a sense that the auto segment is kind of an afterthought for Musk right now. He didn't want to address any of the questions with volume or production. He really only wanted to talk about the potential in robotaxis and robots. That robotaxi announcement was postponed from August 8th to October 10th, and he was very light on the details. He wouldn't even answer if the prototype has a steering wheel or some of those other driver features, which, if they're announcing in October, and he says they should have a rollout next year, is an issue they would already have an answer to. With Tesla revenue growth at just 2% this year, and those expectations for 16% growth next year are in doubt if the car segment doesn't start growing again, because the revenue from taxis and robots are going to be several years out. I think there's still further disappointment waiting. At a valuation of 8 times revenue, unless we see some significant improvement in EV sales over the next few quarters, I'd wait until this one gets back down to maybe $175 a share to start buying again. Google parent Alphabet, ticker GOOG, plunged 6% when it reported on July 23rd and is now down 13% from the peak on the 10th. Revenue and earnings were slightly above expectations, with search ads and cloud revenue helping the company report total revenue up 14% over the year. Now, one weakness was in the YouTube revenue segment, which was $8.66 billion, missed the forecast of $8.9 billion, so that had investors worried that one of the company's best growth engines is slowing down. The biggest fear, though, what we've seen across a lot of these big tech space, is that investors are worried about this massive spending on AI and how badly it hits earnings growth over the next year. Alphabet reported a 91% increase in capital spending, that long-term investment spending on things like AI. The company doubled its AI spending on models to $2.2 billion last quarter alone, along with a $5 billion commitment to its Waymo self-driving unit. All this drove a warning on the profitability margins for the third quarter, which would be lower because of all the spending. With meaningful revenue growth from AI projects still more than a year away, investors just don't have the patience if earnings growth isn't going to be there. Earnings are expected higher by just 13% next year after a 30% pace this year, even as revenue growth tracks in the low double digits. With shares at 6.6 times revenue, Alphabet is one of the less expensive among the group though, and I'd start to look to pick up shares around 5 to 6 times price to sales. Nvidia, ticker NVDA, is the last to report earnings later this month, but has had plenty of news to trade off from the rest of the big tech players. Shares are down 23% from that peak June 18th, so now technically in a bear market of more than 20% from the high, and this one started off as just a normal come down from that excitement over AI spending leading up to the share split mid-June. What so often happens though with these hyper-growth popular stocks is they keep rising as that excitement builds and any risks or worries just get brushed aside. After all, who the hell cares if a stock is getting expensive if it's up 10x in 2 years? But then anything happens to just take a little of that excitement out, like, okay, the stock split, now what? The shares constantly need that next boost, and when they don't get it, the air starts coming out sometimes. When that happens, some of those reasons that were swept under the rug earlier start to float out across the floor, and you notice it's not as clean as you thought, and the selling accelerates. Now for Nvidia, investors are now trying to get a sense of that AI spending trends from those other big tech customers. Several of the Magnificent Seven companies have confirmed massive semiconductor capital investment, but there's still a fear that it's going to slow down as companies realize that the revenue realization from AI is further out than investors want to wait. Already, that meteoric 98% sales growth Nvidia is expected to book this year is forecast to slow to 36% next year, and investors are just wondering if that's worth paying a price of 34 times the annual revenue generated by the company. I would like to see these shares down to maybe $90 each before getting really excited, but the long-term upside is still good if we want to start adding shares here after the sell-off. Looking at the stocks I'm watching this week, Devon Energy, ticker DVN, reports its earnings on Tuesday with estimates for 4% revenue growth and 6.8% earnings growth to $1.26 per share. The price of oil did see some weakness through the May to early June, but remained above $74 a barrel WTI through the quarter and well above production costs for explorers. Exxon and Chevron posted mixed results last week. XOM reported revenue growth while CVX reported lower. Before that economic-driven sell-off last week and the oil hovering around $80 a barrel, I was hopeful we'd see strong dividend increases from the likes of Devon. Now management may be a little bit more conservative over the next couple of quarters, but we're still likely to see some dividend increases with more next year. Shopify, ticker SHOP, reports its earnings on Wednesday with the shares down 40% from the rebound in February this year. The e-commerce leader is expected to post a full-year revenue growth of 22% and 30% plus earnings growth, which puts it firmly in that growth stock theme. The price-to-sales valuation of 10 times here is right at my cutoff for too expensive, so this one has come down far enough. I'm buying shares for that long-term perspective. Shopify has a commanding 27% share of its market for e-commerce-enabled sites, with no other provider cracking 20%. That is a competitive advantage built off unique features and usability. SoundHound AI, ticker SOUN, just cannot seem to hang on to those big swings in the share price. I started buying in February around $3.70 a share, and we saw that massive spike after Nvidia reported an investment in the company. That deteriorated over the next few months, and I picked up more shares. Then, just last month, we saw the shares pop 57% again when the company announced its AI voice assistant is going to be rolled out across Europe through Stellantis, Alfa Romeo, and Citroën vehicles. It's a huge deal, and SoundHound has definitely got that first mover advantage in that AI voice theme that could be big. Of course, the market sell-off has taken the shares back lower, but I'm upbeat about Thursday's earnings report, where we could get more detail into those car rollout plans. Either way, full-year revenue is expected up 53% this year and 47% next, with the earnings loss narrowing to under 20 cents a share. Showing you that bigger picture here with the Sector Spider sector tracker, 5 of the 11 stock sectors did finish higher last week, once again proving that even in this worst market rout, there are gains to be had. Real estate stocks are up for multiple weeks now and are now up 9.6% for the month, beating the overall market index by 13% over the period. Utility stocks have also done very well as investors rush for that safety, and the falling interest rates make for dividend yields more attractive. Energy stocks were hit hard on that volatility and the lower oil prices, but should present good opportunities at these valuations. It does look like that turnaround in real estate stocks is here, with the sector outperforming the market on the 1, 3, and 6 month periods. Now, I've been following the property stocks all year and was probably a little early to the party, but I'm now adding more as those coming interest rate cuts should give the sector that support it needs after 3 tough years. I've been adding the sector-level ETF, the XLRE, along with individual names like Global Medical REIT, GMRE, WP Carry, WPC, and Gladstone Commercial, ticker GOOD. Do not miss that special relaunch discount. Save $150 on the Ultimate Options course, 29 option strategies to lower your risk and increase returns. Get that 3-day coupon code with the link in the description and try it risk-free for 14 days. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.